Hi, it's Fan again here, and I want to welcome you here to the bonus number 2, which is the best 5 chart patterns that profit. Personally, I find that those chart patterns that I'm going to introduce you to, the most profitable and easiest ones to be triggered on a chart, and the most newbies will be familiar with, and they will be more they will be making you more profitability using the binary options smart box system. Here I'm not saying that the binary options smart box system is not going to be working, but it does work. But when you add knowledge and experience to your trading strategy and plan, most of the time you will be doing great and getting more accuracy, and will be avoiding many fakey setups along with the binary options smart box system. So I don't want to take much of your time here, and I want to just dive into explaining those 5 chart patterns. So let's just start with the first one, which is the support and resistance levels. Now, before we just start explaining the support and the resistance levels, I want to just give you a brief introduction here to what drives the market and what forms those uptrends and downtrends. Okay, you know that when something in the market, like for example, when the demand on a potato in the market, I mean in the vegetable markets, for example, I just want to make things clear here. So as I said, when the demand increases on that particular vegetable in the market, you know that the price will just rise up, and the opposite happens when the supply increases on the potato in the market. The prices will just fall down. Okay, sorry, will just fall down. And it's all the same here in the online trading market, in the forex market, in binary options markets. It's all the same. When the demand increases on a traded instrument, the price will rise up for a particular period of time, and that's what creates us an uptrend, like in here, and the opposite as well. When the demand decreases, or when, for example, when the supply increases in relation to the demand, or when the demand decreases, it's the same. The price will fall down, and that's what creates us a downtrend of a traded instrument in a specific period of time. So basically, just keep that in mind. So when the demand increases on a specific instrument, an uptrend will be formed, and when the demand when the demand decreases on a specific instrument, the price will fall down. Okay, so for example, when the price raises up here, so that means the demand has increased in relation to the supply, and that has formed as an uptrend. Now, when it comes to that point, to that turning point, what does it mean is that the demand has started to decrease in relation to the supply, or the supply is becoming stronger than the demand. So that will stop prices from rising up, and it will start to fall down. So this area where the price has changed its direction from up to down is called a reversal point, or a resistance level. So that's the resistance level. And the opposite for when the demand decreases, that has created us a downtrend for a while, for a specific period of time, and then at that point where the price has turned its direction to the upside, that means the demand is becoming stronger than the supply, and the demand has been increasing here. And when the demand increases, the prices will just rise up. So this turning point where the price stopped from falling down and started to go up, to rise up again, is called support level. So this is what we mean by the support and resistance level. So when the price goes up and then reverses down, we call that area where the price has changed its direction a resistance level. And the opposite, when the price fall down and then to changes its direction from to the right to the upside, we call that turning point or reversal point a support level. So that is the definition of what support and resistance levels are, and I hope that it was clear enough for you here. Another thing I want to mention here, and I want to give it as an extra information, is we have when we have results of those repeated and close resistance and support levels. We have a result which occurs which tends to be called support and resistance lines. What we mean by that is when, like in that example or on the price on the chart here, sorry, we have this reversal or resistance point, and we have this second one, and we have the third one. So those, you notice here, I know that you're smart enough to notice that those resistance level happened almost in the same area, within the same zone. In fact, it's within a I think 200 pips or 100 pips. This reversal happened, or this resistance happened here. So when it happens the first time, we don't want if it's going to hit that level, that area again and turn out. But it happened. The second time it happened, we want to take that into consideration. We want to see that, we want to notice that this is a high impact areas for somehow like this, something like this. It's a high impact area and it's affected by the reversal, by the trend, the trends change. So as I said, when we have repeatedly resistance levels, and when we join them or link them with one line, we call that line a resistance level. And same happens when repeatedly and continuously support levels occurs in almost once in one area, or they are close to each other. When we join them with one line, we call that line support level. And in order to, there is one requirement here for making a resistance line or a support line, is that we want to need at least 2 resistance levels or 2 support levels. So when we have more, that's the more chances for price reversal. But 2 will also have an impact of price reversal. And if you notice here, we have 2. You have one line here that has formed by 2 resistance levels, and on the third time the price has reached that level and touched that resistance line. You notice that it has been affected by that reversal area or resistance area, and it just went down again for a while. Same happened here for this area. The price has reached that area and formed 2 support levels here, and on the third time, when we have draw that support line, the price has reached that line the third time, and on the third time it has respected that that support line and went up again. So the price again has been affected by this support area or support line, and it just respected it and went up again. So what I want to say here is that support and resistance levels and lines do play a major part on the chart when you trade. So if you want to make more accuracy on your trading plan or your trading strategy, you really want to include support and resistance lines and levels into your trading. I'm not saying here that the price, that the binary option smart box system is not going to work. It works itself when following all the rules of the system, but extra knowledge and experience will also raise your accuracy and will save you much profits and much money and much time to avoid fakey setups and focus on really working setups. To be honest, I also use support and resistance levels when I trade with binary option smart box system. I take that into consideration, and when I see price reaching a support or resistance level, I want to there is much high probability here for price reversal, so I will wait, just wait for price reversal and wait for an arrow and a valid breakout theory, and I take my trade, and I will be more comfortable taking that trade when there is support or resistance level or support or resistance line. So here, as I said, when you trade binary option smart box system along with the support and resistance levels and lines, you really want to rely on the breakout theory and not the trend continuation theory. I think I have covered a lot here about the support and resistance lines, and I want to move to the second chart pattern that I want to explain here for you today. Double tops and double bottoms. To be honest, those patterns are considered to be the easiest reversal chart patterns, and they are reversal chart patterns, and they are not continuation chart patterns. I think that everyone who will be having a good introduction and explanation to what double tops and double bottoms are, he will be really friendly with them and will be familiar with them, and it will be easy for him to trigger and spot those patterns on a chart. So what are double tops and double bottoms? A double top is double top pattern is formed when price tries to rally. What I mean by rally is to rise up, like in here, but it does fail to break that previous resistance level. And a double bottom pattern is formed when the price tries to drop, but it fails to break that previous support level and went up and goes up again. These chart patterns are very reliable chart patterns, to be honest. So how can you identify a double top and a double bottom pattern? In order to trade double top or double bottom patterns, the following rules must be kept in mind. So a double top pattern requires the number one rule is that price rallies to previous resistance. The price rallies to a previous resistance, but it fails to break it out. As you see here, it hasn't break above that previous resistance level. So here you wanna wait for price to reverse and a selling arrow or a red arrow to pop up within that reversal, and check if a breakout theory is valid, and then place your trade in accordance to the time frame you are trading on. So basically, at a double top, you want to see if there is a previous resistance level, and when the price just goes up to that area to reach that resistance level, and when it doesn't break it out and it starts to reverse, you want to wait for a popping up arrow to pop up to show up, and you want to validate that trade with the breakout theory. And when it does, when everything is okay and everything is valid, you want to take your trade based on the time frame you are trading on. Same for double bottom. The number one rule is the price need to drop to a previous support level and attempts to break that level. When that support level, when it doesn't and the price starts to reverse, you want to look for a buying arrow to pop up, and once it does, check if there is a valid breakout theory, and then you execute your trade based on the time frame you are trading on. So those are what double tops and the double bottoms are. So a double top, just to recap here, a double top, there must be an uptrend and then a downtrend, and that will create us a resistance level. Now we want for price to reverse and try to reach that previous resistance level. If it doesn't break it out and it starts to reverse, we want to wait for a selling arrow to pop up, and once it does, we want to confirm with the breakout theory, and then we take our trade based on the time frame we are trading on. Same for the double bottom. We want to wait for price to drop and then reverses up. When it does, it will form as a support level here. When the price tries to and attempts to go to that previous support level, and when it doesn't break it and starts to reverse up, we want to wait for a popping up arrow to show up on the chart and valid that trade within the breakout theory. So, and then we take our trade based on the time frame we are trading on. So that's all for the double tops and double bottoms, and I really want to move quickly to the third chart pattern that I want to introduce you to today. The third chart patterns that I wanted to talk about is the triangle chart pattern. To be honest, the triangle chart patterns, there are three types of the triangle patterns: the ascending triangle, the descending triangle, and the symmetrical triangle. Those chart patterns are commonly found on charts on the forex market, to be honest. And those patterns represent a period of consolidation, and then the market decides its direction, whether to go up or to go down. Okay. But keep this in mind: those patterns require one criteria to be met, which is the 4 points of reaction within the triangle. So let me just explain that right away. We first start with the ascending triangle, and as you see on the picture, this triangle is formed with 4 reaction points: the first one, the second, the third, and the fourth. And this triangle can be identified by a horizontal resistance line right here. This is a horizontal resistance, and I'm not saying any line, I'm saying horizontal. There isn't line like this or line like this going that way. It's just horizontal resistance line and a rising up support trend line here. This is the support when the price reaches and it goes down, and it takes that point into consideration, and it takes that line as a support and it rises up again. So we call this a rising up support line. This pattern occurs within an uptrend or within a bullish market. I see bullish market, you know that a bullish market is when the market is rising up. So that's it. And from the picture, you notice that to form that support trend line, it has required 2 reversal points here to be a valid trend line. And you know that a trend line must at least have two reversal points. So I think that you already know this. So this has formed as the rising up support trend line. And the way we predict the next move of the market is by waiting for price to close with a full candle full body candle above that horizontal resistance line. And then when it does break, we are 100% sure that the price or the market is continuing in a bullish trend. So the techniques that we can apply here along with the binary option smart box system is using the trend continuation theory, and you can find more in-depth explanation video when you refer to the modules area, and you will find a full video explaining that theory. So keep that in mind. The rules for spotting an ascending triangle is a horizontal resistance line formed by 2 resistance points, and a support rising up trend line formed by 2 support points or levels. And when the price breaks above the horizontal resistance line, we use the trend continuation theory to trade the system, and popping up arrow, of course, and then we take our trade. This pattern is for the trend continuation traders. The second triangle chart pattern is the descending triangle chart pattern. This pattern occurs in a bearish downtrend. In a bearish trend or in a downtrend, in a bearish market. We can identify this chart pattern by a horizontal support line here, a horizontal support line, and a falling down or a resistance trend line. This one, a resistance trend line. As the same, this requires 4 points at least for identifying or for the validation of that pattern. And if you notice here, we have the first, here we have 5 points, but at least we need 4 points. Now the first point, the second, the third, the fourth, and the fifth. For the horizontal support line, we need at least 2 reversal points or 2 support levels. And for the resistance trend line, we need at least 2 resistance levels, and combine them, and that way we will trigger the descending triangle. And we can predict the next move of the market is the same, just waiting for price to for the market to cross and close below with a full body candle below this horizontal support line, and then we will be 100% sure that the market is bearish, and we can use the trend continuation theory in order to trade with that chart pattern. And again, if you refer to the module's homepage, you can find out more in-depth explanation video of the continuation theory. So now we move to the third and the last triangle chart pattern, which is the symmetrical triangle. In fact, this pattern is characterized by both rising support trend line and falling resistance trend line, and this pattern can be found on both market type of markets. In fact, you can find it on a bearish market, you can find it on a bullish market, or you can find it on a downtrend, or you can find it on a uptrend. And as I said, it's characterized by 2 a resistance trend line and a support trend line, and there is no horizontal trend line or support trend line. It's just a trend line, just like that. It doesn't matter. It's not horizontal. It's not required to be horizontal. Any support, any resistance and support line, and the same. There must be 4 reaction points inside that triangle. The first, second, the third, and the fourth. As you already know, in order to form a resistance line, we need at least 2 resistance levels, and the same if in order to form a support line, we need at least 2 support levels. And this pattern indicates a period of consolidation to both sides with support and resistance. Unlike the other 2 patterns, the symmetrical triangle can break out in any direction, which makes it a little bit trickier, as it may give you fake outs. As you see on the picture here, there is one solution to predict the breakout of that pattern, and the way it works is you wanna know the previous trend before this pattern has formed. So if the previous, I didn't included here any previous trend just to not make you confused. So when the price, if the previous trend before the formation of that particular triangle chart pattern, if it's bearish, if it's bullish, then we can predict the next move to continue in the upside. So when the price breaks that, we will be predicting that the price will break that pattern to the upside and not to the downside. But if the if the previous trend before that chart pattern formation is bearish, it was going down, we can predict the next move of all the breakouts of that triangle into the downside. So here I think we have covered a lot about the triangle chart patterns, and now you will be able to identify those triangle patterns. The next chart pattern I want to talk about is also very easy to be triggered, and is clearly spotted anywhere on any chart. It's the head and shoulders chart pattern, and I'm not talking about the shampoo in here. It's just a chart pattern. It's commonly found in stocks market, in fact, but it's also we can also find it in the forex market, in the currencies market. And why it does happen on the stock market a lot is regularly is because of the high volume. But as I said, we can also find it in the forex market, and it can be traded profitably if you trigger it well. And if you trigger it at the top of an uptrend, that will indicate the end of that uptrend, and it will reverse down soon. And it means that the start of a reversal to the downside is coming in. On the opposite side, if you find it's inverted, just take the inverted head and shoulder pattern is the mirror of that pattern. It just becomes like this, down, that way down, and then that one, the head, and then the left shoulder, the head, the right shoulder, and then the price will rise up. So when you find it at the bottom of a trend, maybe the market was going down, and then we found that pattern, that will indicate the beginnings of a price reversal to the upside. The head and shoulders pattern is characterized by three peaks. The peaks, I don't know if you heard of that before, but the peaks are three reversal points, and those are the peaks. When the reversal points are to the upside, we call them peaks, and when the reversal points are to the downside or in the bottom of a trend line, we call them troughs. So as I said, the head and shoulders pattern is characterized by three peaks. Those peaks, the first, the second, and the third, with the middle one being standing out from the other two. What I mean by the middle one is the head. The head is always higher than the right shoulder and the right shoulder. So the peaks here on when the head and shoulders is formed within an uptrend, the head will be higher than the left shoulder and the right shoulder, and when the chart pattern happens within a downtrend, the head will be lower than the left shoulder and the right shoulder. And you want to really try to understand these requirements. This pattern occurs when the buyers take control of the market for a while, resulting in an uptrend. Then it reverses down to form as the first peak, which is that one, the left shoulder, as seen in the picture here. First, the price, the buyer tries to make an uptrend here, then they fail to, and the price will reverse down. Once the price reaches a support level for something like this, the buyers will push the price back up again, and they take it higher than that previous high here. We call that high, or the left shoulder. This shows us a possibility of for forming that pattern, but we will need to confirm with the head formation, this, well, which is the second peak. We want to see another, we want to see this high here, we want to see another high made here, and it's above and it's higher than the left shoulder or this previous high, and then it reverses down. Now the price should drop, the prices, after the price drops, we want to see it rising up again for a while, and then it reverses down to the downside, and we want to see that peak here to be lower than this high here, and we call this the right shoulder. And that way we get that pattern. So we want a peak here or high here, then another high which is higher than the previous one, then another high here that is lower than the middle one, and that will create us, this one will be called the left shoulder, and this one will be called the head, and this one will be called the right shoulder. And this line here that combines these support line here for both peaks here, we call it the neckline. So when we are at the end or at the top of a trend, of an uptrend, want to wait for price to reverse, want to wait for price to cross that neckline, and then we will be trading down in a downward position. And when we have that pattern mirrored to the downside at the end, at the bottom of a bearish trend, we want to wait for price to cross above the neckline, and we will be trading in an uptrend only. And how we want to trade with this is when the price is by waiting for selling arrows to pop up, and then we take our trades based on the trend continuation theory only, and there is no breakout theory here only. To be honest, you won't be facing that pattern regularly, but in sake of education purpose, I just wanted to introduce you to this pattern that you may find sometimes, and you will be able to recognize it and know what it's going to do or what is going to happen after that chart formation. So now I think we want to move to and finally I want to move to the last chart pattern that I want to explain here, and I think that this pattern is a very important and regular formed chart pattern that occurs too many times, especially during high impact news and the important economic news releases such as non-farm payroll and unemployment reports and something like this. So let's just take a look into it right now. The flag pattern. This pattern is known as a continuation pattern and not a reversal pattern. Okay, it's known as a continuation pattern, not a reversal pattern. It forms after a bullish or a bearish trend, as seen on the picture here. We have a bullish trend and it's been formed here, and a bearish trend and it has been formed here. And okay, this pattern happens because the market wants to take a breath off and make consolidation within this flag pattern, and then continue to go in the same direction that has preceded the flag formation. So the same direction. What I mean by the same direction that has preceded the flag formation is the previous trend, and the trend here has been bullish, so the next move will be going bullish, and same here for the bearish flag. We have a downtrend, and then we have the flag, and then the next move is to the downside, of course. To be honest, this pattern is easy to be spotted, and it can be found, as I said, it can be found within high impact news and important news releases such as the unemployment reports, and especially the non-farm payroll. As many people become afraid of the non-farm payroll, I find it very easy and entertaining news releases to play with, especially in Forex sometimes, and making bank with a lot of pips here. So the way I want to just move to explain the way how to identify a flag. which the first thing we want to see is the post or an uptrend or a downtrend before the flag formation, a very strong trend, almost a strict and consecutive uptrend and candlestick patterns, bullish candlesticks patterns or bearish candlesticks patterns here. And then we get the flag itself. So within a bullish trend, we want to see a bullish trend, and then the flag will be going to the downside, will be bearish. Okay, the consolidation here will be bearish, and it's not going to be to the upside, it will be going to the downside. And the opposite for a bearish flag, we want to see a downtrend or a post here, a strict downtrend, and the consolidation will be going to the upside, and it's not going to be to the downside. And after the consolidation, we will have the second move of the trend. A bullish flag is identified by the upward movement and or the flag post, and then a downward sloping flag as shown on the picture here. An uptrend and then a sloping, a downward sloping. What I mean by sloping, a consolidation here to the downside, not to the upside, as I mentioned earlier. As price starts to consolidate and move gradually lower, we want to look to buy after the breakout of the flag. And here we want to use the trend continuation or breakout theories. They both work here. So and what basically I like to do sometimes is to trade within the flag formation. What I mean by the flag trade within the flag formation is when the price starts to do these peaks and troughs here, or these support and resistance levels. I want to see if there is something like double tops, double bottoms, something like the support and resistance levels. And I like to wait for an arrow to pop up, and I use the trend. I use the breakout theory here when I trade within the flag formation. I like to use the breakout theory, and I take my trade. And to be honest, it's a little bit riskier sometimes. But if I find that there is much room for price reverses to be consolidating here, I will take the trade and will take the risk. But if there isn't much volatility within the flag formation, like only 20 pips, I will not take it. I will not take the risk. But if it's more than 30, 40, I will take the trades here, and I will be having much room for price to correct and to make trend and the correction. On the other hand, the bearish flag is identified by a downward post or a downtrend, and then an upward sloping flag or a bullish consolidation, and then the price starts to consolidate here and move gradually higher. So when it does this, I want to wait for selling positions when the trend, when the price breaks below the flag or break the flag out. And as I said, we can use both trend continuation and the breakout theory. They both work here, but we always need an arrow, popping up arrow. Okay, and same here. As I already mentioned, I also like to trade within the flag sometimes, even bearish or bullish. I always do this. And as I said, I want to see more volatility. If the volatility is dead, I don't want to trade, because basically there isn't much room and there isn't much probability for price to make a trend and then a correction, price and trend correction. There won't be much room and they will be just losing. So I think I have explained everything here. What are those chart patterns and how I trade them, and what techniques you want to trade with them, and I also gave recommendations and what I do with those patterns using the banner options smart box. So I think that's the end of that chart pattern course video, and after that you got at least one valued point here that I have been trying to deliver in those 40 minutes, I think. So thanks. I just want to thank you for watching that video until the end, and don't forget to go to the next video course. There will be explaining the secrets of using the Fibonacci tool, which is very important course, and it's basically the thing that I wanted to deliver, but I just added these first two courses here just to bring you closer to what I'm going to deliver in the next course, which is a little bit for advanced traders, but I will make sure and will do my best to explain it in a very simple way. So thanks for watching, and I see you.